Welcome, everyone. Thank you for joining us tonight for our CattleFax Trends Plus webinar. And with that, we are very grateful to our sponsor tonight. It's Purina Wind and Rain program. We will have a chance to hear from Dr. Perry at the end with Purina to tell us a little bit more about this program. So we definitely appreciate Purina's sponsorship in this activity. So tonight, brief roadmap of where we're going. We're going to start with the CalCast survey results. Then Mary will take over and walk us through the corn and hay situation, our cattle supplies and fundamentals, and then the outlook for these summer and fall markets. So starting out with the CalCast survey, thank you so much to everyone who participated in the survey. We greatly appreciate your contribution to this data set. It really helps us with this analysis and keeping a current history of this survey. So again, thank you so much to everyone who participated. And so this year we had 385 head as the average cow herd size for these respondents within the survey. We had just under 1,000 responses that made up this overall cow herd size. This year cash cow costs at around $50 from year ago levels. You can see here, this does not include returns to management or depreciation costs, basically those non-cash expenses. We asked those as separate questions, and so unpaid labor and management came in at $147 per head, and depreciation costs were reported at $134 per head. And so if you add those up, that totals just over $1,000 per head for cow cost. And so again, that's pretty significant, but on the flip side, calf revenue jumped up sharply this last year, almost $200 per head to $1,600 in terms of revenue on a per head basis. Looking at it on a per hundredweight basis, that came in right at $300 per hundredweight. So again, quite a bit of a jump from 2023 that far outpaced that increase in cow costs. Average weaning weights were roughly steady in the survey this year, and they've been holding steady to just a hair lower the last few years. And so probably a lot of that is just due to the lingering drought conditions, and then also maybe just a few more efforts on a little bit more of a moderate herd size or moderate frame size animal. Recognizing that there is significant variation between operations, between regions, and resource bases, we do break this out on a regional standpoint within our results packet. And so as we look at cash cow costs, this past year we saw the biggest jump in the Southeast region, increased almost $45. However, this $691 is still the lowest cash cow costs across the nation. And a lot of that just comes back to the increased forage availability and supply at a lower cost. Conversely, the Northern Plains was almost steady last year. That being said, they had a significant jump the previous year in cash cow costs. And so again, this past year, they were mostly steady, but they remain the most expensive within the United States. And a lot of that just comes back to the increased need and cost of forage. And so as we combine some of those components, we look at cash cow costs here in green. We look at calf values. That allows us to take calf crop or to make adjustments based on weaning rates to calculate an average revenue. One of the things that we've traditionally done in this survey response is we'll break responses up into low returns, average returns, and high return operations to kind of get a better understanding of what drives some of these differences in net profits. And so again, these return groups are sorted out based on this average profit. Do want to point out that this uses the cash cow costs. It excludes those non-cash expenses such as labor and management, depreciation. And on the flip side, it also excludes revenue from the sale of cull cows and bulls, which, as we all know, has been a significant value the past few years. And so you'll see us tie back to these low and average and high return groups here throughout this presentation, just kind of, again, identify some of those variables that separate them. So as we start in this process, we'll look at calving distribution broken out by percentage of calf crop born, or the percentage of operations with 75% of their calves born within the first 45 days, within 46 to 60 days, and then 60 and above. And you can see here, this is the response rate. And so on a US average, in the green bars, almost 45% of respondents recorded having 75% of their calf crop born within the first 45 days of that interval. As we compare that to the high and low return groups, a few things jump out at us. First off, just how much or how large of a percentage of these high return operations calve within the first 45 days compared to some of these higher or longer calving interval windows. Whereas on the flip side, low return operations, you'll see a larger portion of them a little bit further out, a little bit longer, more spread out calving window. And so one of the reasons we talk about this is a strong measure of efficiency in that it creates further opportunities within the management of that herd to add value. And one way it does that is through weaning weights. So fairly practical from this standpoint. When you have more calves born earlier on in that interval, you wind up with a heavier, more uniform calf crop as they just have more time to grow before weaning. On average, steer heifer average weaning weight this past year was 537 pounds. Then you can just see how that kind of has broken out over the last few years. On average, mostly steady, but down just a hair, particularly within that first 45-day window. As we then take those weaning weights and tie it into our calf crop percentage, again, we can break it out by calving distribution. And note that in addition to having heavier weights at the time of weaning, we also wind up with more calves. We have a higher weaning percentage for herds with a larger portion of their calf crop born in the first 45 days. And that is just that those females or those cows have more time to undergo uterine involution after parturition and start cycling again. And so that leads to increased fertility, which then leads to increased longevity in the herd. And furthermore, just a higher weaned calf crop percentage, more calves to sale, and higher calves or heavier calves at the time of marketing. So as we look at that, a common measure is to consider the pounds weaned per exposed female. Last year on average, it was 468 pounds weaned per exposed female using that weaned calf crop percentage here. And then again, we like to break it out by return group. You can see how those high return operations that had a larger percentage of calves born within the first 45 days weaned heavier calves. And so again, this all creates kind of a feedback loop that really supports some of these operations. Moving on a little bit, as we start to look at weaning length or different weaning methods or how these calves are marketed, we break responses out into operations that ship straight off the cow, wean 35 or 30 days or less, and that's wean 31 to 45 days or greater than 45 days. And then we can start to look at value on that. And so first off, just on a response rate, around just under 25% of operations within this data set shipped their calves right off the cow, while a larger portion, close to 55%, weaned for a minimum of 45 days before selling those calves. And so when we look at how that breaks out on a dollar or a value per head basis for those calves, there's a few interesting tidbits here. First off, you can see that operations that weaned for 30 days or less, there's almost no benefit to that. In fact, some years there's actually a small decline in value. And that's just because of those higher risks associated within that short-term weaning interval, within that weaning time frame or that process. You do see some increased health risks there and that price reflects that. Last year it was almost flat, but then as we start to go up a little bit, say operations that wean for 31 to 45 days, we did see a small increase, but typically it's not substantial. This past year is $100. Previous years it's been a little bit lower, and that mainly just accounts for that added weight gain on those calves. There's not an extreme value for that weaning process there. That added revenue is, again, just for that 2 pounds per head per day that those calves are growing. Where you really start to see that increase in value is for those operations that wean for over 45 days. Those calves, last year it was a larger jump, and that's pretty consistent across time that we'll see the marketplace rewards producers for putting in that effort to wean and vaccinate for over 45 days. So again, a lot of value to be had here for the fairly large percentage of responses in our data set that do wean for more than 45 days. So as we think about other ways in which to add value to those calves, one that we get a lot of questions on is use of value-added programs. And so a lot of these programs require different management techniques. They require third-party audits. And so you can see over the last few years that on average, these or inclusion in these value-added programs have declined ever so slightly. Producers within or that participate in these programs will typically participate in multiple programs, and so that's why these percentages will be greater than 100. But you can see operations that do not participate, that rate is increasing ever so slightly over the last few years. And a lot of that is due to just the decrease in value added or the additional revenue noted for some of these programs over the last few years, as calf prices have increased so much just due to that tightening of calf supply. We've seen that proportionate value or added value above that base level slightly decrease, just as calf buyers are becoming a little bit more needy, if you will, in terms of what they're looking for. And so some of those values or added values just aren't quite as strong as they were, say, 3 or 4 years ago. That being said, these value-added programs do typically add or create sources of revenue for these producers. But one of the things we oftentimes stress or recommend is that when undergoing one of these or enrolling in one of these programs is to ensure that you have a marketing plan in place to take advantage of the additional work, the additional costs, the additional audits associated with some of these programs to make sure you're capturing that value. As we look at vaccination protocols, we ask producers at what stages in that calf growing and weaning cycle do they vaccinate their calves, and on average, producers give around 2 or just over 2 vaccines in this data set. And so when we look at that, you can kind of see the response rate or where producers are giving those vaccinations. Again, it's at branding and then again at weaning on average. But then you can see how much that value increases across time for those additional vaccines. And you can see that beyond 2 vaccinations, there's not much growth or not much increase in calf value for those additional shots. And so that's something that you may ask yourself if you're one of those producers in that 3 or 4 vaccine category. This might be an opportunity to maybe save a little bit of money, because oftentimes we'll see that that increase in value for these additional shots does not offset that increased cost associated with the drugs, the increased labor costs, and not to mention the added stress, and therefore sickness or injury risk that comes with working these calves. So as we look at that, this chart allows us to kind of break apart that weaning program utilization and the number of vaccinations and kind of compare them independently. And so it removes some of those combination effects there. And so you can see the number of vaccinations are 0, 1, 2, 3, 4. And so within each of these weaning programs, you can see that average general increase between particularly 0, 1, and 2, increase in calf value associated with those, within each of the weaning strategies. And so this will maybe give you a little bit of consideration. If you're someone who's weaning and vaccinating, you can kind of look at where you might fall within this data set. That being said, again, it's survey responses, so you will find some outliers. And for example, here's one that is most likely an outlier, where someone who's in probably one of the value-added programs gave 0 vaccinations, weaned for more than 60 days, and saw above average calf value. So again, you do have to recognize that, but again, this is useful for seeing the trends within those weaning programs. So as we take this a step further, or take it to the next stage, we're looking at marketing avenues or strategies or routes. And so again, percentage of responses, so response rate that sell at different stages. And so you can see that response rates for the auction barn and then for retained ownership are pretty steady. Small decrease last year in direct trade, and as well as forward sale or forward contract and video sale. But then we can look at the value of these animals within each of these categories and kind of make some more observations there. The auction barn is consistently the results in the lowest price calves, but oftentimes that's a little bit more of what we would call, say, commodity calves that maybe don't necessarily have the weaning programs or the value-added or vaccination programs. Those oftentimes fall more into these other categories, which you can see last year had pretty similar values on average on a per head basis. So as we look at that, we look at these operations that do retain ownership. Again, small percentage, only about 1/4 of operations in this survey do retain ownership. But then we ask them, what stage are they retaining ownership through? And so you can see that last year, a small increase in that backgrounding. So again, that weaning and vaccination program, and then a small increase in summer grazing. Winter grazing actually decreased slightly last year, and retaining through the feedlot was mostly steady, but down just a little bit across the last few years. But again, this shows that a larger percentage or portion of operations are selling these, or excuse me, a smaller percentage of operations are selling calves off the cow, so a larger group of them are retaining, at least according to this. And so again, some interesting observations. A lot of people are trying to capture some of that added value of these high-priced animals later in the stage. It also creates good opportunities for just diversification of that revenue stream, and then also managing around some of the seasonality within our calf markets that Mary's going to talk about here in a few minutes. So another data point that is frequently well loved by the seed stock operations, but we ask for the average bull purchase price for the last year, and then we break it out into these categories, these response rate categories, for how much these bulls cost, and then what that means to calf value. And so across the last 3 years, for every increase in $2,500 spent on bull purchase price, it's resulted in an $85 per head increase in calf value. And so say if we assume a bull is in the herd for, say, 4 years or sires 75 calves, that results in an added profit or added revenue of over $6,000 on that additional $2,500 investment. So really good return on investment strategy there. And so this really tells us that efforts at improving the genetics of that herd do pay off in the long run. As we start to look ahead a little bit, one of the questions we get a lot is herd expansion and different ways in which producers look at that. And so this is herd expansion and method intentions for operations intending to expand this year and how they expect to do that. And so, of course, retaining heifers is far and away the largest percentage of responses, but surprising amount of producers will also expand by buying bred heifers, by buying bred cows. And so this tells us for operations that are maybe selling bred females, there's some opportunities here to increase that value or increase that revenue. So when we think about all this and we try to wrap it up, one of the long-term trends we've noticed is just the change in cow cost, or the change in dynamics between these low return, average return, and high return groups. And so as we look at these groups across the years, you'll see that the average return and high return groups are pretty similar in their cow costs. There's not a huge difference there. And so the difference between these groups lies, or within the average and low return, lies on that cost standpoint, that cow cost. They really have higher cow costs, and that's what separates them from those average and high return groups. The inverse can be said when it comes to calf value. You can see here that across time, low return and average return producer groups typically have fairly similar calf values. There's not a lot of change there. But that high return group really stands out in terms of what they're doing to market these animals, how they're adding value to this calf crop. And so again, as we look at this, one of the long-term takeaways has just been that low return operations really stand out in terms of cow cost. High return operations really stand out in calf value. That's how they differentiate themselves. And so we think about that. High return producers really make a lot of effort, particularly on the marketing and reproduction side. Obviously, they start with low costs. This top chart tells us that. Comes to the management aspect, but then they focus heavily on the health of the herd, the nutrition of the herd, the genetics, all of which leads to improved reproduction. And then these tie up and allow producers to then improve their marketing efforts in terms of calving rates, weaning percentage, and use of either value-added or vaccination or weaning programs. And so with that, I'm going to turn it over to Mary to take it away to our next segment.
Thanks, Matt. Yeah, I'm Mary Kurzweil. I'm an analyst here at CattleFax as well. Like Matt mentioned at the beginning, if you have any questions, go ahead and type them into the chat and send them that way, because everyone's stuck on mute. But yeah, we'll get into, starting out here, we'll go into weather. So if we look at where we're at today, overall, there's quite a bit of drought here if we look at the Southwest and then also in the Northern Plains. So that is a little bit troubling as we head into the spring and summer. But at the same time, if we look at the Corn Belt and the key regions there, several of them are more neutral areas, and then there is some dryness as well. So that's also a concern from a corn perspective, but we also have a lot of areas that are still in pretty good shape, particularly some good cow pasture areas. But for going into the summer, this is a pretty dry situation, particularly in the Southwest. As we look for this next, or what we've got coming ahead, the latest ENSO probability says that we're going to be in this neutral pattern here, at least through the next several months, and likely through the summer and into early fall. So that's those gray lines on that top chart there. If we look at what to expect from these neutral patterns, it's actually pretty green here in this bottom left chart. So you can see that there's usually some pretty good moisture through the Corn Belt and a lot of the cow pasture areas, some Missouri, and then the southeast there. And even the Southwest does tend to get moisture in these neutral patterns. And we saw in that previous map how red that was in that zone. So that should bring some relief if it follows this pattern. West Texas is still going to be dry. Some of those western states, so Utah, Nevada, those are still looking really dry. And then if we look into the fall, neutral pattern is still the most likely to this point. That could easily change, but if it does change, it's most likely going to be La Nina, which again does go back to a drier pattern still. So this fall expectation is showing neutral, but if it were La Nina, it would look pretty similar there, with really dry in the South Plains and then dry out west. And decent moisture is typically still seen kind of in that Corn Belt area in the neutral. Not so much in the La Nina, but to a degree, a little bit more moisture there versus the west. But just generally fairly dry as we look ahead. Looking at corn, so we've got our latest corn reports coming out. If we look at where we were last crop year, they just kept lowering the stocks to use. So the supplies kept moving lower in the reports. And so now we're moving back to about a 10% level for stocks to use, at least to finish the previous crop year. And so with that, we did see corn prices move higher. But to this point, we're looking at record production, at least according to the most recent report, as we look ahead. And that's coming from increased acres and then expecting some large yields. And if we look at the Corn Belt that we saw in those previous maps, I do think that we can expect at least generally good yields there. Of course, that's pretty hard to predict. And then we should have a lot of corn acres being planted. But if you look at where we're finishing this current crop year, we are approaching that 10%. And if we think back to 2020 and 2022, that's about the threshold where we do tend to see supplies tight enough to support those high prices that we saw in that time. So that's definitely a risk, but at this point with the expectations and the corn planting expectations, we should see a comfortable stocks to use level for corn, which should keep prices pretty range bound between $375 to $515 as we think about this year for this new crop year from now through next May. And that's going to be a little bit higher than a year ago, but pretty stable with the prices we've been seeing. Looking at hay, we did see great hay production in 2024. And then we're expecting some good production here in 2025 as well, but we don't have as many acres planted. So as we look at this year, we are up 8 million tons from a year ago, or in 2024 we were, and that was really coming out of the good weather that we had for hay production. And then from a demand standpoint, we're looking at some of the tightest cattle numbers that we've been seeing. So demand should be a little bit slower. But even with that, with the dry weather that we're seeing, the dry patterns, we do still see that regionalized to some degree. And you can see that in the West, we've seen higher prices there, which makes sense with the dry weather that they've seen there. And here it shows the North is looking at really cheap hay. I think that's just a good production year here lately. But if we look ahead, I do expect that it'll be pretty dry there by the time we get into the fall. So could be good to secure hay ahead of time if you are going to be looking at using it this winter for your cows. Looking at cow inventory. So we'll go through the inventory and supplies, and then we'll get into the prices. So we're looking at the smallest beef cow inventory going back to 1962 to start 2025. We do think that this is the low for this for the cow herd for this cycle. If you look at 2026, we see a slight increase there, so just barely, and then we start to ramp up to true expansion in the next couple of years. A lot of times we do hear people comparing back to the previous cycle. I think it's important to note here, a key difference that we see for this cycle compared to the last is you can see in 14 going into 15, we saw a small increase to the inventories. And then over the next 2 years, we saw almost a 2 million head increase to go into 2017. So we don't expect that kind of rapid expansion because we're not keeping enough heifers back at this point, and we are still battling a lot of drought. And so, and if you look back at the last cycle in that bottom chart there, you can see how many more replacement heifers we were keeping back and developing. And this year, we're not seeing that. So 2025, we actually saw replacement heifers down again. We do still expect that small increase to the herd going into next year, mostly coming out of smaller cow kills, so less culling, and then keeping a few more heifers back as we move on forward. Dairy cow inventories, I think a big point to realize on this top chart is that we're looking at about a difference of 100,000 head here over the last 10 years. So it really hasn't changed too much. It's been pretty stable. But if we think about this year, we've already seen the numbers getting close to that 9.4 million head because they do release monthly inventory data for our dairy. And so what we're seeing is we're seeing smaller cow slaughter and we're seeing profitable margins on the dairy side. So they're making money with milk, and then they're also seeing those high coal values and the high prices for their day olds and just high prices throughout the industry. So they are looking to expand. The limitation here is, again, with the lack of replacement heifers. So replacement heifer prices have gone up a lot. If you look at that bottom chart, you can see that replacement heifer supplies are extremely tight. We do expect them to start to increase, but a lot of what happened here was breeding more of the dairy cows to the beef, to a beef bull to get that better beef animal, and then to increase their income because they can sell those day-old calves for a lot more, and they perform better on feed. But the problem was is they didn't breed enough of them back to dairy, and so they just don't have enough of them out there to grow the herd, and it's really been more maintaining it. So I think there's enough economic incentive to expand. Now they just need the replacement heifers back, and we are seeing a shift to more of them breeding back to dairy. And so that also means that we will see a few more of the beef on dairy pulled out of the supply going forward, or they weren't bred. We won't see quite as many bred to the beef as we did in the previous years. So ultimately, looking at slaughter, cow slaughter, you can see we're down a lot from the peak that we saw in 2022, and nearly all of that is coming out of the yellow. So if you look between the yellow and the purple, purple is dairy, the yellow or the top is the beef. You can see that this year we're expecting, or last year we were down over 1 million head, and almost all of that came out of the beef. And this year we're expecting to be down another 400,000 head. Most of that coming out of the dairy, actually most of that again coming out of the beef, because we've already seen a lot of the culling that we're going to be able to do for both of them. If we look at 2026, we've got it about steady with another decline to the beef cow side, and maybe a small increase to the dairy cows as we do see a few more of those replacement heifers available. But still generally small cow slaughter as we look ahead. Looking at the fed side, cattle on feeds coming in smaller than a year ago. Updated data as of April, we were down 180,000 head, and this data did release the heifers on feed as well. So we're down 180,000 head from year ago levels, but up a little bit from March. But the heifers on feed are coming in. Most of that decline is coming from the heifer side. So that says that there's a few more heifers being kept out of those feed yards. As we look into May, where the report comes out this Friday, we're expecting to continue lower with decent marketings that we've seen and then slower placements. Part of that being from fewer imports from Mexico, but then also just a smaller outside supply given our small cow numbers. So cattle on feed is going to continue lower as we move through the summer. And that's just going to remain below year ago levels as there's just not as many cattle out there. But as we look ahead, we probably will see that the low coming in the late summer. But as far as cattle available to be marketed, we're getting near the low in the next month or two, and that's where we typically see the high come for prices. But we'll get into prices in just a minute here. One part of that cattle on feed is we are seeing fewer cattle coming from Mexico. I'm sure a lot of you are aware, but there's the border's now closed for any cattle imports from Mexico. It did reopen for a while, towards the early part of the year. But to this point, it's shut now for an indefinite amount of time. So if we don't see it open anymore, year to date, we're at 225,000 head have already come across this year. If we compare it to the last couple years, it was 1 million head more than that. So if we're not able to get any of those, you can see the chart here. It shows just how big of a drop compared to a year ago that is in that supply. So if we don't get any more, that's 1 million head. If we're just closed for a month and we're able to get a lot more in, then that's still a 400,000 head decline. So that just kind of says that situation is going to keep our outside supplies tight, and the on feed, that's just another reason for those on feed numbers to stay tight compared to the previous few years. So ultimately, with what we know today, we're expecting slaughter to be down about 600,000 head for the year. So far we're down about 200,000 head. Through May, we could easily end up being down closer to 300,000, and then the rest of that to come later in the year. But if we don't start to see any cattle coming from Mexico, that could start to show up by November slaughter, where it's down a little more than that. And then especially going into 2026, where we expect to be down 700,000 head, it could be down further than that, again, if we don't get to see any of those imports coming in from Mexico. So we expect the actual low for the slaughter to come in 2027 before we do start to see the benefits of the cow herd rebuilding in 2028. So we're definitely going to continue to drop slaughter just out of the fact that there's fewer cattle on feed and then fewer outside supplies available to place. One way that we've kind of made up for that on the production side is by increasing weights. So last year we saw a 27-pound increase for cold carcass weight. And if you look at this chart, you can see that over time, there is an increasing pattern. And so it makes sense that we've continued higher, but that big year-over-year increase was the equivalent of 1 million head in additional slaughter. So production last year stayed relatively strong, and a lot of that was by the increase in carcass weights. We expect another pretty large leap this year, so up 12 pounds is the forecast here. Part of that has been more days on feed, so really maximizing each animal. Feed additive that can help with that as well. Exterior has been fed for a lot of animals. And then another part of that is this is cold carcass weight, so total slaughter. So that's cows, heifers, steers. And as we do continue to retain heifers and see that smaller cow kill, this is going to be made up of more steers, and so that will naturally increase this as well. But generally expecting another pretty large increase in weights this year. We've already seen it. I do think by the second half, we'll see smaller year-over-year increases, and that's just because the days were already added by the end of last year. So we're seeing more days on feed, and weights are going to continue higher as we look ahead. So ultimately for production, like I said, that really offset the decline to slaughter. And so particularly on the non-fed side, so that ends up that slaughter was nearly steady in 2024. For 2025, with smaller non-fed and fed slaughter expected, we're still looking at a 1.7% decline in production, and then another 2% smaller in 2026 with where our current forecasts are. So we are going to be looking at smaller production. One way that we've kind of made up for that also is from the import side. So we're exporting less. So looking at 2025, our expectation is to be down 10%. We did end up a little bit stronger than we would have expected in 2024, just down 1%. But with producing less, we will see those exports continue lower. But the big story here has been the increase to imports. So in 2024, we were up 24%, a huge year-over-year increase. And this year, we're on pace to be, well, we're expecting to be up at least 5%. And we've been so strong through the first few months of the year that we could easily be up more than that. So a lot more beef is coming in from imports, and that's coming in the form of mostly lean beef. So really kind of helping supplement our supply from a lean beef and ground beef kind of standpoint, since we're not killing as many cows. So we expect that to continue, especially with the prices that we're seeing and paying for that beef. That continues to pull more product in because our demand is so good for this product. So what that does for consumption is last year we actually ended the year higher. So production ended up steady, and then we saw the increased imports and a little decline to exports. So we actually ended up 1 pound higher in our per capita net beef consumption. This year we are still forecasting a small decline, but if we do see that increase of imports, if the increased imports are even stronger than what we've got forecast, we could easily see this steady with year ago. Now, at the same time, if we do see more of a drop to slaughter because we don't import any more cattle from Mexico, we could easily, of course, move production lower, and that would move this smaller. So it could go either way. but so far we haven't really shorted the market. But as we look through the cycle, in the next few years, as our production does continue smaller, we will start to see that tighter beef supply and then smaller consumption. But the demand has continued to be strong and outperform our expectations to this point. So if we think about 2024, like I said, we increased our production or our consumption by a pound. And we still saw a big year-over-year increase to prices. And so that's just showing record or near record demand. And then as we look this year, we're still going to keep our consumption probably near year-ago levels, and we're still seeing another increase with the latest retail beef prices reaching $8.50 a pound. And so that just really speaks to the great demand that we're continuing to see in the beef industry. And that's just more money and more dollars in the system that can get passed down through all the segments. And so moving into the cutout, so this is the wholesale beef market. This cutout is kind of a way to standardize that and average it. You can see that if you look at that gray dotted line, we would be near the peak for the cutout now. But if we look at the past 2 years, so we've got 2023 and 2024 on here, you can see that the peak has come later the last couple years. And I think that trend is going to continue, where we might still have another month before we do see the high to this cutout. But generally, we would expect the high to come near that 355 to maybe 360 range through the summer, or reach there in the summer before it does tend to see some pressure. As we get later into the summer, we do tend to see large kills, and demand does typically drop off a little bit past the 4th of July, where we see some pressure on this cutout. But generally, we should be pretty range bound with support at 310, and then upside up to 360 potentially. And then if we look into the fall, we generally see another push for Labor Day, and then a push through into the end of the year for the holiday ribs and those items. So near term, we are pushing into highs, and that's reflected on into the Fed market and other markets as well. So looking at the Fed price, we've seen record prices here, record highs, and just a lot of upward momentum here lately. If we look at the past couple of years, we've seen the peak coming in June or July. But if you look at that gray seasonal, it would suggest that it's more like March, April. I would again say that we're probably going to follow more what we've been seeing lately as far as the later high. So these cattle are being fed longer. And so we'll probably see more of a tight supply later than what we normally would because we're feeding them for longer. But generally expecting an average price of 205, but with where we are today, over 220, I would say we're near the top end of the range, at least short term. Before we typically soften, probably find a trading range here in the summer, like we have the past couple years. What that range is, it's kind of tough to say, but it could be support at 210 or support at 205, and then trading kind of between that maybe 210 to 220 range as we move through the summer. And then you typically see a little bit more pressure late summer to early fall when demand is slower. And so there's where we do see a little bit more risk to the market. So maybe closer to that $2 to 205 later in the fall, or late summer to early fall. And then typically, if you look at that seasonal pattern, that gray dotted line, we do see that push at the end of the year. And we expect that again this year, maybe to take out the highs that we're seeing now, but it could easily not as well. Last couple years, we haven't seen the late rally push take out the highs in the summer. Looking at the feeder cattle, these prices have just continued to trend higher, which isn't in line with the seasonal pattern. But if we think about the tight supplies, especially taking a lot of the Mexican feeders out of the mix, tight supplies have really supported this higher trend here. We would say the upside, we've got a range for the year between 265, which we saw in the first week. So we don't really see prices going back to there. anytime soon, and some upside up to 305 or maybe even 310 for the feeder cattle. But an average price of 285 is kind of the expectation. We did take out that $300 a hundredweight range last week just for a day or so it's not there on the chart, but generally we should be pretty range bound now, and then typically you see that push in the fall. So we might drift a little bit lower with some pressure here in the short term before we do tend to see that push late summer to early fall. Looking at calves, again, looking at record values here for calves. We've got a 360 average as kind of our forecast here for the year. With where we are today, we just took out 380 and are continuing to trend higher. But we think that we're probably near the high here as well. If you look at the seasonal pattern, calf prices do tend to drift lower through the summer and into the fall. We do think downside's a little bit more limited here because tight supplies, of course, is going to continue to drive these values. But we do expect a little bit of pressure on these just with where they're at today and the other segments as well. So if we look at average cattle prices in general and the beef here, you can see we're at record levels here for 2025. Took out the previous cycle and have really been trending higher and pretty steeply here as well. So we've seen a lot of the big jumps kind of out of the cycle. So if we had 2026 on here, it'd be pretty tough to say if it's higher or if it's more steady, because I do think that we're approaching kind of the annual highs for the cycle as we think about where we're at today. Looking at utility cow prices, cow values, of course, with the tight non-fed slaughter, these values are going to remain elevated. We're continuing to see that. I think we're probably near a peak here as well, but expect these to average at the 140 range. With the seasonality that you see here, you can see that we're probably near the peak, but we can stay at these levels through the summer as we do see really good ground beef demand before we typically see an increase in availability in the fall and prices kind of drift lower. But generally, these are going to be well supported by the tight supplies. Looking at the bred cow versus fed cow values, you can see that the bred cow values have increased pretty aggressively over the last 3 years. So up 26% and then 32%. And then this year we're up 27% from last year, which was already, of course, a record high. We think back to the last cattle cycle, that was a pretty quick increase. And it lasted 2 years, or they were high for 2 years, and then they moved sharply lower. Like I said, we do expect this cycle to be kind of a slower increase in supplies, and that also means the slower decrease then in prices because supplies aren't going to jump up nearly as rapidly. So all in all, we're looking at more dollars in the system as we think about the cutout, the whole, or even at the starting at the retailer, record high prices there, and then that goes down to the cutout, and then to the cattle feeder, the stocker, and the cow-calf guys. So if you look, we're looking at record money in the system, and if we look at where that's going, more and more of it is continuing to get passed back to the cow-calf guy, and that's typically what we see in a healthy industry. So that helps support the expansion that we do expect that we're starting to see here. That's all I've got. So again, any questions, feel free to put them in the chat or email either Matt or I after. Otherwise, we're going to hear from Dr. Perry here, or Matt. I think Matt had one more thing here. Here we are.
Thank you, Mary. So quick plug for folks, if they wish to see more, we have a risk management seminar coming up that will be in person, held at our offices here in Denver on June 18th through 19th. Visit our website for more details. And then our next cow-calf webinar is scheduled for September 24th. So with that, I'll turn it over to Dr. Perry, who is the Director of Beef Technical Solutions for Purina Animal Nutrition. Again, with our sponsors, we are very thankful to have them. And he's got a little bit of a discussion for you all as well. And so as you have questions for us or for Dr. Perry, please, again, feel free to put them in the chat.
Okay, thank you, Matt, and thank you everyone for the opportunity for me to talk to you tonight. As we talk about calf value, one of the things that we've been asked, how can we help our producers add value? And what we're talking about tonight is what we call our Wind and Rain calf program. If we could hit the next slide, please. A little bit of history. One of the things that, when I'm talking to producers, this is the type of stuff a lot of times they're talking about, and I really do believe it, like we've heard for the last hour, I really do believe this is the time in this high calf prices. This is when producers need to try stuff. This is when they need to see which programs work in their operations or see what kind of changes in their operations they need to use these higher value, the higher value product programs. Because as this, when the cattle cycle turns and the calf price starts coming down, that's going to put a big squeeze on these cow-calf producers, and then we're going to need to get every dollar out of every calf we can. Not only get all the cows bred, calf for every cow in the whole 9 yards, but we need to focus on how do we maximize the dollars out of those calves, and that's what this program is all about. So if we could hit the next slide, please. The basis of this program it's based on the mineral feeding. And I think most of you are aware of the old Texas ranch to rail data, where they looked at the number of calves that get sick that are consigned from a ranch based on their mineral program. And this was a really interesting data set. I remember talking about it back in the IRM days and the BQA days. But one of the things that was impressive was they found that the herds where the calves are on a good mineral program, very few of those calves get sick. So it's a really health related thing that one of the things we look at with our mineral program that we are working with producers on all the time. Next slide, please. One of the things that came out of this was a couple of years ago, we literally had feedlot order buyers come to us and ask if there was a way for us to identify herds that are on a complete mineral program. And that was a surprise, but when they came to us, they were asking because they knew the Texas ranch to rail data, and plus their own experience, they understood that when, again, those calves that are when mom's on a good mineral program, some of this gets into fetal programming, which is a whole nother discussion. But the bottom line is the calves are when you've got healthy cows on a good mineral program, they have healthy calves, and they know that when those calves hit the feed yard, they've got a more active, robust immune system, which certainly gives them a fighting chance in the feed yard. So that's what this program is about. It's the world's simplest program to get into. If we could have the next slide, please. Basically, what this is, we're identifying calves that are on our mineral program and working with the local dealer, the local Purina dealers, and what they're finding is those calves, how we identify they're on is working with your dealer. It's the cows that have had two bags of loose mineral per cow, or one 225-pound mineral tub per 2 cows, or we can mix and match it. That's always, the devil's always in the detail. But the bottom line is that's all it takes to be in this program. And we were surprised with the uptake we had in that. And then we had a lot of questions for, can I do this with stocker calves? So the stocker calf program is new, working with buyers and with some of the vet services. What we're finding is it's a 60-day program. So the stocker calves they're in a stocker program or backgrounding program for 60 days, and they have gone through either 15 pounds of Wind and Rain mineral or a stress tub, both of which boost the immune system, just everything we're looking for. So the stocker program is fairly new. Next slide, please. To our surprise, when we launched this, the folks at Superior really took off with it, and they've worked with this program very hard, and they've been our leading participant in that. We are also working with Western Video and then the Joplin Regional Stockyards. We're also working with a lot of smaller local feed stockyards on an individual basis. So it's kind of one size fits all. Lots of people can participate in this program. And then if I have the next slide, please. As you know, okay, so this is the simple form you fill out. You basically fill this form out, the producer's name, number, their information, and then that follows them to the feed yard, or to the sale barn, or the marketing program, and then those calves are listed as the Wind and Rain program. This is done. It's been very good for us. The first year, Superior did 23,000. Last year was a little over 38,000. Our goal this year is 60,000 head. And one of the reasons this is working, if I could get the next slide, please. As you know, next slide, please. What happens after this, after every year, after the sales are done, then Kansas State, working with Merck Animal Health, they analyze all the value-added programs that go through Superior Sales. And we had enough, it takes a certain amount of groups of cattle. We had enough groups of cattle that they actually they ran this through, and then in 2023, the Wind and Rain calves were worth $5.48 a pound, more about $31 a head. So when we ask why, what's going on, and that's what really came back again to verify what the buyers asked us to begin with, is to identify those herds in a complete mineral program. We don't have the 2024 data, as I understand. All of the values are down, but we were still positive. We're waiting to see that, and someday I'll update that slide. But we're very happy with a program that the mineral program, which is good for the cattle and good for production, or also we can identify ways to increase the value of calves. Next slide, please. So if you want more information, I know that was very quick, but we're running out of time. But so contact your local Purina dealer. The local website of the PurinaMills.com/MVAP. That will take you right to the mineral value added program cattle. Again, our goal is 60,000 head in 2025. If you have any questions, feel free to contact me under either one of those. With that, thank you very much for letting me participate this evening.
Thank you so much, Dr. Perry. With that, I'm looking to see if we have any questions. Thank you again for everyone who's attended tonight's discussion. Again, or as a reminder, if there's any follow-up questions that you think of after the fact, feel free to email any one of us, and this will be uploaded to YouTube so you can watch it again if there are certain slides you wanted to go back and spend a little bit more time on. We understand it's a lot. All right, well, thank you all so much. We hope you have a great night, and again, we look forward to seeing you in September at our next webinar.